As we look at the outlook for investment in 2014 and beyond in the private equity field, we see a greater alignment of the institution's return goals and risk profiles with the fund managers. The investors are seeking a greater percentage of investment on behalf of operators and fund managers. In the past, 2 or 3 or 4% investments were sufficient on behalf of fund managers, and we're seeing in the marketplace today that operators and fund managers are being asked to put in more significant amount of co-invest and have more skin in the game. But more than that, the terms have changed significantly. In the early years of the private equity real estate funds, fund managers could anticipate receiving a promote that was measured by a catch-up and by 80-20 and 70-30 and even as high as 50-50 levels of return. We're not finding that as the norm in the private equity fund real estate business today. We're seeing greater alignment in terms of each putting in, for example, 90% by investors, 10% by the operators, achieving a 90-10 return until investors have received a double-digit return on their investment, and then shifting to an 80-20 and maybe at a high double-digit, high teens return, shifting to a 70-30 return. So the marketplace has changed. The marketplace has changed for the better because money can now dictate having an opportunity to invest through many fund managers and not be limited to the early years when there were so few fund managers. The other change that we're seeing in the private equity real estate fund management is the movement by investors to align themselves with operating partners, operating fund managers who are not only allocating funds to other operators, but who are predominantly real estate operators in their own right. Managers who can acquire properties without other intermediaries, so that the sharing of the value and the sharing of the increase in value of the properties is not layered with several parties receiving promotes, but with only a single promote between the fund manager and the investors. So it's a movement towards fund managers who have feet on the ground, fund managers who know how to operate real estate in their own right and can acquire directly on behalf of funds. We do see that there are opportunities in 2014 and beyond for those fund managers who see that there have been changes in the structure of fund management fee sharing, who are willing to move forward on that basis, and who are themselves real estate operators, managers, and developers who can bring returns to investors without layers of fee sharing. So yes, there is movement and room forward to do well in 2014 and beyond, but for a different group of real estate operators as opposed to just fund managers.